ladies and gentlemen, I'd like to introduce today's first speaker, John Bollinger. John Bollinger is the president of Bollinger Capital Management, a firm that provides money management and proprietary technical research. He's the creator of Bollinger Bands, which are utilized worldwide for analyzing the financial markets. His book, Bollinger on Bollinger Bands, has been translated into 12 languages. His site, BollingerBands.com, is the hub for everything related to Bollinger Bands. Ladies and gentlemen, please give a warm welcome to John Bollinger.
Thanks, Adam. Good afternoon, Chicago. We'll try once more. Good afternoon, Chicago. Okay. You guys are just not really awake. I know it's Sunday and all of that. So everybody stand up. I don't want anything in your hands. Just everybody stand up. And repeat after me. Say, have you heard about Harry, the trader that just got back from the floor where he was needed to trade the bellies? Let's do it all together one time. Now that you know it, you've learned it, let's do it all together one time. Oh, say, have you heard about Harry, the trader who just got back from the floor where he was needed to trade the bellies? So, a little bit more awake now? Yeah? Good. So, I get asked a lot of questions. I've been in the business a very long time, and people call and email and write and ask me a lot of questions. Many of them are about Bollinger Bands, but more and more I hear these days people asking, how can I learn to be a great trader? How can I learn to be a market technician? How can I do what you have done? How can I achieve the sort of success that you have achieved? And I think the best way to answer that is to explain a little bit about how I've done what I've done. And maybe along the way, we can look at some of the literature that I've found to be very important and some of the ideas that I've found to be very important in putting together a career in this business. So this story I'm going to tell you starts when I was 10 years old. My grandfather, who was a grand old capitalist, gave me 10 shares of a company called Wyckoff. Has anybody ever heard of Wyckoff? A couple of you. So in order to understand this story, you have to understand that in its day, Wyckoff was the technology play of its time. It was like the Google or the Netflix or the Broadcom or the Intel of its time. What it did is it made truck bodies. We call them containers today. But this was the new technology that allowed intermodal transportation. So this was one of the hottest stocks on Wall Street and one of the most sought after plays. It was considered to be a giant growth stock because, as we know, this was just at the very beginning of the container era, and we know today that virtually all shipping goes by containers. So they were right about the growth of the container business, and that this was going to be a growth category, but they were wrong about the stock. So my grandfather gave me 10 shares of this stock. I don't know how much it was when he gave it to me, but it represented a fairly good bit of money. And over the next 10 years, I watched it go from there to zero. Right? And it was the best possible lesson that you could give somebody. The worst thing that can happen to a trader is they come in, they're hot, they've learned all the tools and the techniques, they're ready to go, and they make a hugely profitable trade. Right? And their ego goes woof, and their head goes wee, and they go, I'm Superman. Right? What you really want to have happen is you want a trader's first few trades, first few positions to be disasters, so that they learn how to cope with pain, they learn how to cope with loss, and they learn how to deal with the hard side of this business. Because if you learn that, then dealing with the upside is really easy. Because dealing with the dark side is what separates successful traders from non-successful traders. So I went to school, as you might imagine, high school, and then I took a year off and studied photography independently, and I enrolled in an art school, the School of Visual Arts in New York, to study film and specifically cinematography. I was very interested in light and the interplay of light and how the eye-brain mechanism worked and how we absorbed images and all of that. And I took a job in the afternoons and evenings working at a place called the Museum of the Media. And I worked as a technician for them, helping them put together shows and museum exhibits and such like that. The interesting thing was that the Museum of the Media was run by the Globus brothers, three Globus brothers. They were the sons of Globus Inc. Most of you won't recognize that name, but if you had been traders during the 60s, it was the #1 over-the-counter underwriter in the U.S. And during the go-go years, it underwrote almost, 2/3 of all of the go-go stocks as they came out. So these boys had serious money. I mean, really serious money. And the Museum of the Media was, just something that the sons undertook as sort of, a hobby, shall we say. But it gave me a job and it allowed me to work my way through school, which is what I needed. I actually had 2 jobs. I worked at night at a place called the Electric Circus doing light shows. So it was a time where I didn't sleep much, studied a lot, and worked a lot. But the Globus brothers, it was really interesting because I learned a lot about the stock market from them, because I got to see, what it looked like from the dealer side, from the people who put deals together and make them and sell stock to the public. So that was very influential for me. But afterwards, I started on a career in the movie business, and first as an assistant cameraman, then as a cameraman. And I really kind of forgot about the market for, 6 or 8 years. I just didn't pay any attention at all. My mother was getting ready to retire. She was the first woman executive. I know there's a lot of interest here in women trading and such like that. My mom was the first woman executive on Madison Avenue. Right? She worked for a company called McManus, John and Adams, and after some years, she went out and formed her own agency, and she put together a nest egg in terms of a pension plan. And she said she tried various things of managing it with brokers and insurance people and so on and so forth, none of which had worked out really well. And she called up one day and said, "Look, you know about stocks and such like that. You're interested in all that. Why don't you take care of my retirement plan for me?" And I said, "Well, gee, I got this career I'm doing." And she said, "Really, I could really use this because, if I don't get this right, I can't retire. And I really, it's getting to be time to retire." And I knew that she'd already had one heart attack, and so I said, "I'd do it." And I did it the way that most responsible people in the day would do it. I went down to the brokerage firm and I got some brokerage research and I tried to learn the fundamentals of some companies, and I started reading The Economist and the New York Times and Barron's and the Wall Street Journal and all that. And I just, pulled together everything that I could and tried to make some good investment decisions. And it was a pretty hard time to be doing this. It was in the late 70s. We'd had the giant bear market just behind us, but we really hadn't recovered from it. We were now chewing sideways in a very volatile market with big up and down swings. And frankly, I wasn't doing really well. Let me put it more bluntly. I was doing terribly. And I couldn't understand why it was that I was doing terribly. Sitting there was this book. Right? This is Robert Edwards and John McGee's Technical Analysis of Stock Trends, the 5th edition. It was the last edition that Edwards and McGee worked on together. We're now up to the 10th edition or the 11th edition. So this is the last edition that the original authors wrote. And it was just lying on the table out there in the middle of the brokerage office. In the old days, it was very hard to get stock market data and such like that. So the brokers would have like a bullpen out there in the middle of the office with desks and quote machines where active traders could sit. And so this book was sitting on one of those tables. And I actually walked around to the various brokers in the firm and asked whose book it was, and nobody would own up to owning it, right? Because this is the bad old days. Technical analysis was not something that you did in polite company, right? So I asked my broker, if I could borrow it. And I took it home and I read it, and it was like somebody turned on the lights. Right? I got it. I like really understood what was happening to me. I understood why I didn't have good performance. I had good ideas, but I had terrible timing. And technical analysis of stock trends talked all about timing. So I figured that if I combined the good analysis and the timing, I would do better. And that turned out to be the case. So this was the seminal book that I read that turned my life around in terms of the market. So the name of the book is Technical Analysis of Stock Trends, written by Robert D. Edwards and John McGee. John McGee was the real engine of the two of them. There was a prior book to this by a technician by the name of Schaubacher back in the 30s. It was Edwards who came from that lineage, and he partnered with John McGee, and they put together this book. It was published in 1966, at least the version that I had, by John McGee, Inc., out of Boston, Massachusetts. And, it talks about basic technical analysis, about patterns, about supply and demand, about support and resistance, about trends, about overbought and oversold conditions, all of the sorts of things that you really needed to know about if you were going to operate a portfolio, and which fundamental analysis, which was all that the brokerage firms would be willing to provide at those days, absolutely understood nothing. But the juncture of the two pieces, fundamental analysis and technical analysis, looked really interesting, and I called that rational analysis. I gave it a new name. So that sort of got me going, and it was also the very late 70s by now, and the microcomputer thing was starting, and so you had to build your own computers, and I did that. I bought a S100 mainframe, and I bought a CPU card and an I/O card, and 4 8K memory cards. 8K, right? Those 8K memory cards cost $250 or $300 a piece. That's in 1978 dollars. Right? So I put this together, and I got the CPM operating system and a little spreadsheet called SuperCalc, and I started to try to program, some technical ideas, and I started to try to enter some data and see what I could do, whether I could gain an advantage. And then really fortunately, I found this book. And this is, you can tell by how worn this book is. This is actually the book that I found. This is Technical Analysis Explained. It is by Martin Pring. Martin's going to be at this conference, and if you have the opportunity to get to know him, to walk up and shake his hand and meet him, he is a grand gentleman and really a brilliant market technician. So I found this book, I'd say maybe a year after I found Edwards and McGee. It was published in 1980. I probably stumbled across it in 81, somewhere's right in there, published by McGraw-Hill out of New York. And Martin talked about trend analysis, and even more importantly, he introduced me to market structure, how the different pieces of the market work together. We call it now sectors, like different economic sectors, and even more importantly, how those sectors trailed one another or led one another over an economic cycle. And that was really, really valuable information for me. It covered interest rates, which up until then I really hadn't considered, but we were in the middle of a giant interest rate storm. So, Martin got me to think about the impact of interest rates on stocks and sentiment, and even more importantly, he said, it's not just the U.S. market, there's global markets as well. There's markets in Europe, there's markets in Asia. You need to consider all of that as well. But there was one more thing that was really profound to me. The back 1/3 of the book was all data. And I kept on going, why in the world would somebody print data in the back of a book? And I thought about this a lot, and I said, my God, it's because he does data-driven technical analysis. That's what he's doing. That's what he's trying to say. That's the real message in this book, is that it's data-driven technical analysis. Is that not topic number one today? Right? Data mining and all this? Well, back in 1980, Martin understood that. And that set me on the right path. I started entering all that data into little spreadsheets and stuff and calculating indicators. And then by then I had, I really had a leg up. I had, tools and techniques that other people didn't have access to. And I was able to do really interesting things in the market and make decisions. The next book I got, the third book on technical analysis I got, was the Dow Theory, written by a guy by the name of Robert Ray. This is published in 1930 or so. Now, you have to understand, this is all happening 79, 80, 81 in there. So there's no internet. There's no, and just finding a book like this is a problem. So there was a guy by the name of, who had a little company called Needham Bookfinders, and you could write your request on a postcard, and you would take it to an antique store, and you'd kind of like walk in like a supplicant, and you walk up and say, please, ma'am, would you give this card to Mr. Needham? And they'd take the card, and about a month later or 6 weeks later, you get a letter back, your book's available for pickup, and you go back to the same little old lady in this antique store and say, hi, my name's John Bollinger. Do you have a book from Robert Needham for me? And she'd pull out The Dow Theory by Robert Ray and hand it to you. And, you felt like you were privileged. I mean, it was like, you can't imagine how hard it was to get information about the market, to learn things about the market. But this was a terrific book for me because this is where I learned trend following. So, and really came to understand what trend following. And in this book, Robert Ray actually puts together a mechanical trend following system. Pretty astonishing for 1932, if you think about it. All right, he took a version of the Dow Theory and he put it together with some other pieces, and he created a mechanical trend following system. And so that was just hugely influential to me. I said, wow, we can take this another step. This is not just about trading. It's not just about rational analysis, but we capture those big trends on the charts. It's really important that you understand, in those days, trading was a pain. right? The spreads between the bid and ask were a mile wide, right? And the brokerage commissions were huge. I mean, a ticket, one ticket could be $50, $60, $70, and that's just one way, right? On one trade. And data, you couldn't get any data. The only way you could get any data was by sitting down in a brokerage firm. And by then I was fortunate enough, they gave me a desk out in that bullpen, that very same bullpen where I found that first book. And so I was able to sit there and make trades and see market data. So this book by Robert Ray really discussed trend following and the benefits of trend following and the penalties of trying to fight the trend. It started with Charles Dow's work, the creator of the Wall Street Journal and the averages. And the back half of the book is all of William Peter Hamilton, who was the editor of Barron's, all of his editorials in which he worked with Charles Dow to formulate the Dow theory and all of that over the years. So this was an enormously important book to me. And by now I knew what was going on. I could trade. I could sort the signal out from the noise and stuff. And I was sort of on my way. But I had heard that, during the 40s and the 50s and into the early 60s that there was this thing called the formula plans. Anybody know about formula plans? Have we completely forgotten about them? In the post-World War II era, everybody wanted to invest because, all of a sudden the economy was booming, jobs were aplenty, people were making good money again, there was economic recovery. People wanted to invest, and they had the same problems with market access and access to research and everything that everybody had. And this world of formula plans opened up where people developed mechanical plans to invest their money so that they didn't have to deal with brokerage house research and such like that. You've heard of dollar cost averaging. This is the world in which dollar cost averaging was developed. Right? This was one of the original formula plan ideas. So this book, New Methods for Profit in the Stock Market by Garfield Drew, published 1950 by Metcalf Press out of Boston. Two things. First of all, it talked about, instead of trend following, Garfield Drew tried to wrestle with the idea of forecasting. Not just, following the trends, but trying to figure out where things were going to go and what, where inflection points might turn. So this was the first book that I saw that really tried to dig into forecasting ideas and forecasting methods. Formula plans were discussed at length, and then I went on from this, and I bought another dozen books on formula plans. It turned out that it was actually a huge phenomenon that really only died with the ascendancy of the mutual funds of in the late 60s and early 70s in the go-go years. People shifted from formula plans to using mutual funds and professional management instead. But prior to then, formula plans were essentially the poor man's approach to mutual funds. He also talked about cycles, which became a very important part of my research, and more importantly, he talked a lot about market psychology, and I'd started a whole series of researches on market psychology. So the next book that I took on was New Concepts in Technical Trading Systems by Wells Wilder, perhaps the single most important technical analysis book ever published. This is the book in which RSI, the Relative Strength Index, appeared. It's the book in which Average True Range appeared. It's the book in which parabolic stops appeared. It was just an important, it's hard to express its importance because it both looked at indicators to try to understand what was going on in the market and mechanical ways of putting those indicators together into rigorous trading systems that took the emotions out of the marketplace. So Wells is still with us today. He lives in New Zealand. I was actually in New Zealand a couple years ago. I thought I'd knock on his door, but I just didn't do it. So it was published in 1978 by Trend Research out of Greensboro, North Carolina. It was one of the first major books, major successes in terms of an investing book that was self-published. Prior to that, self-publishing was often the case in the technical world because it was hard to get the regular publishing houses to take these ideas seriously. But by this time, it became clear that self-publishing was the way to go, and this basically ushered in a new era of self-publishing with people like Robert Prechter publishing all of their own books and such as they went forward. So it talked about the relative strength index, directional movement, average true range, which was very strongly related to Bollinger Bands and volatility and such like that, and the parabolic system, which gives us the parabolic stop, which is a really good risk management tool. And then this book came along just about into my life just about the same time that book did, and it talked more about, this is Perry Kaufman's commodity trading systems and methods. It's his seminal work, and this really taught me the idea of, drove me deeper into thinking about trading systems and methods. So published in 1978. I probably didn't get my hands on it until about 1982. And this is where I really got into the idea of mechanical trading systems. So let's actually go back a stop here. At the time, we had a trading system using percentage bands on the Dow. We used a 21-day average and 4.5% bands. So each day we'd plot a 21-day average and a point above it, 4.5%, and a point 4.5% below it, create a channel. And we kept a couple of oscillators, one with advanced decline information, one with up and down volume information. So if we tagged the upper band and one of those oscillators were negative, it was a sell signal. We tagged the lower band, one of those oscillators positive, it was a buy signal. We were using that, but the problem with that is you had to fit the bands over time. There would be times in the market when the bands needed to be wider, times when they needed to be narrower, and you had to change the bands from stock to stock to stock. 4.5% may work for the Dow, but maybe 15% for a growth stock, or 5 or 3% for a utility. And in drawing those bands and setting the bands, we let our emotions into the process. If we were bullish, we drew the lines to present a bullish picture. If we were bearish, we drew the lines to present a bearish picture. So I was looking for a way to automate that process. And I was an option trader studying volatility. And I looked at this, and I looked at average true range and a bunch of other mechanisms. I realized that I could start setting the width of the bands with volatility, and that would take the emotions out of the trading process. And that's the genesis of Bollinger Bands. Right? That's how we got there, say circa 1983. And so since then, Bollinger Bands have been pretty well adopted across the planet. Everywhere I go, I just toured Scandinavia. People were really interested in Bollinger Bands there. They're incredibly popular in Asia. Of course, they're popular here. So the idea of having bands that are adaptive and take the emotions out of the process, define high and low on a relative basis, becomes sort of a universal idea. But it was these volumes, it was this work, this basic technical analysis work that allowed me to get there. But there's one author I haven't talked about yet, and I do this because I don't have a single book that I could recommend for him. And that's Richard D. Wyckoff. He wrote about a dozen books in his career. He edited the magazine of Wall Street for some 10, 15 years and founded a stock market school. I've listed like 5 of his books here, How I Trade and Invest in Stocks, Stock Market Techniques 1 and 2, which is really a condensation of articles that appeared in the magazine of Wall Street. My Secrets of Day Trading in Stocks, Wall Street Adventures, Ventures and Ventures Through 40 Years, which very late in his career, and studies in tape reading. The reason I commend this to you is Wyckoff understood markets better than probably any other analyst then or now. Wyckoff, Richard D. Wyckoff, really understood markets and really understood the mechanisms that drove markets and how prices were set in the marketplace. I highly recommend his books. They're hard to get. They're all out of print, but they're not impossible to get. You just have to work a little bit. You have to find a Needham bookfinder in order to get some of them. But interestingly enough, in the past couple of years, some back issues of the magazine of Wall Street have started to show up on the internet where people have started to scan them and archive them. So a search on the internet can help you find these. And I highly commend the work of Wyckoff to you. So a final reminder, by and large, the original editions are the best. Do not go out and get the latest bloated editions of these books. I specifically recommend these editions because I think they are the best editions of these works. Many of these books now are 800 pages thick and such like that, and I think there was more real information in the originals. So our teacher masterclass tomorrow here on the Monday the 23rd from 1 to 4 p.m. If you can make that, it'd be great to see you. There's a beautiful young woman in the back of the auditorium over there who has some DVDs of my seminars if you're interested in getting really in-depth introductions into Bollinger Bands and all the related trading systems and tools. And, of course, my masterclass tomorrow. And then here are some websites that you could visit us. BollingerBands.com. On BollingerBands.com, each week I prepare a chart pack of 24 market timing charts. It's available for free if you go down near the bottom of the page on BollingerBands.com. Each week I publish it. It has a variety of stock market timing indicators that I've found to be useful over the years. And then BollingerBands.us is a website that we partnered with another company to provide all the Bollinger Band analytics and such for us. And then finally, if you have any questions, you want any more information, etc., you can email me at BollingerBands.com. It's bbands@BollingerBands.com. And I will be happy to answer any questions that you have. Thanks for spending some time with me today. Enjoy your stay at the Money Show over the next couple of days. Some brilliant people are going to be here. Take time to meet and greet them, and take the time to meet and greet your fellow attendees. It's a fantastic opportunity to get to know other people with using other tools and techniques. Thank you so much.